All right. Hey, everyone. It's Serge Berger here. Let's get started here in just 1 minute. Before we get started, I want to make sure you can actually hear me and you can see the screen. So if you could quickly type in a yes or something like that, just to make sure I'm not talking to myself. Very good. All right. Perfect. So let's see here. How is everyone doing today? Everything good? Let's see here. What we are going to do today is talk about stock market sectors and groups. Specifically for the US stock market, we discussed this in the previous two webinars a little bit. What makes the US stock market very nice is, or one of the benefits is that it's very well divided up in between different groups and different sectors. And that's a great benefit if you want to be able to have an organized market, or at least an organized way in which you look at the market. So that's the theme for today. Again, keep in mind that we have a 16 series in total that I will be doing for Roboforex. So far, we have covered some basics, looking at which types of stocks are good to trade, benefits of the US stock market or stocks versus, say, Forex. And in this webinar today, we are talking about sectors and groups. In future webinars, we're going to do some more technical analysis and more strategies, and so on and so forth. But today we can talk about sectors and groups, which is a really, really important building block for what we are going to talk about in future webinars. So firstly, though, before we even do that, I want to do just a quick review of what we talked about in the last webinar. Number one, the US stock market is very large, and as you can see here in this graph, it makes up about 60+% of the entire country weighting of the MSCI World Index. So in comparison, you can see, for example, the Japanese or the United Kingdom stock market only make up like 9 or 7% respectively. So the US stock market is very, very large, which means more liquidity. To a good extent, it also means more transparency, and really it also translates into more opportunity. At least that's how I look at it. So that's just a quick review here, so you can see the size of the market it's very, very large. And this piece of cake here, this 60% piece, is divided up into a lot of different stocks and sectors or groups, and that's what we're going to talk about today. What is this cake made up of? What are all the different moving parts in here? Last webinar, we talked about the best stocks to trade, and as a quick review, the best stocks to trade, in my opinion, are the ones that are very liquid and the ones that have a market capitalization at least somewhere between a mid and large cap stock. Some small capitalization stocks I think are okay to trade. It just becomes a little bit more difficult in terms of news flow and the orderliness, if you will, of how some of those smaller cap stocks trade is sometimes a little bit less than favorable. So I like to focus on stocks that are very liquid, and certainly if you are going to be a beginner in trading the US stock market, I would certainly recommend you to start with the large cap stocks, and many of those are tradable on the Roboforex platform, so that's going to be very good for you. Okay, now more in the categories, and this now already gets us into sort of the sectors and groups, or at least indirectly so. Again, just as a quick review, large capitalization stocks, $5 billion or more in market capitalization. Again, market capitalization is basically just taking the stock price, multiplying it by outstanding shares. So $5 billion in market cap a large capitalization stock, that's what that falls under. Just so you know, for example, Apple, which is the world's largest stock by market capitalization, has a market capitalization of more than 600 billion. So obviously the large capitalization category has a very wide range as well. Mid cap is somewhere between large and small cap is 300 million to about 2 billion in market capitalization, roughly speaking. So you can break up the US stock market not only by sectors and groups, which we will talk about in today's webinar, but also by market capitalization. Then we talked about in last webinar, we talked about, you know, the blue chip stocks, which is really the largest of the large caps. That's your Apples, your General Electrics, your Facebooks, those type of stocks. We can also break down the US stock market into growth stocks, value stocks, and even very small cap stocks, which are penny stocks. I wouldn't advocate anyone trade those. I just don't think that those are very good instruments. Some people would argue differently, but in my opinion, those are very difficult stocks to trade. So you can see that we can break things down in multiple different ways. In terms of sectors and industries, again, we were going to talk about, this is going to be the main focus for today. Interesting sectors and groups, in my opinion, because they're more dynamic, are technology stocks, particularly semiconductor stocks, anything internet related, social media stocks, such as Apple, for example. Financial stocks, large capitalization banks, even some regional banks in the United States have a lot of liquidity and very interesting stocks to trade. Then trends or fads, as you like to call them, stocks like GoPro and Fitbit. These are just some names that a lot of people like to follow, even though they're not necessarily great appreciating stocks. They tend to be very good from a trading perspective. And then you have consumer-oriented stocks, which is your retailer stocks, like your Walmarts and restaurant chains like McDonald's, those type of chains, those types of stocks that everyone knows, I think tend to be very nice as well. So you have a lot of different ways in breaking down these markets, and again, these are just some of the good-looking sectors and groups within the U.S. stock market. Also, I think good stocks to trade are stocks in the news. So you can check your favorite news feed, excuse me. For U.S. stocks, I think MarketWatch.com is a good one. Bloomberg.com is a good one as well. I would think MarketWatch.com is a little bit more specific to just stocks, whereas Bloomberg.com is a little bit more institutional in nature. Then again, of course, we want to focus on liquid stocks, news flow. You want to make sure that stocks that you're going to be focusing on do have some sort of steady news flow, that it's not erratic, it's not full of surprise news. You want to make sure that any stocks you trade aren't going through major pending lawsuits or major major mergers and acquisitions or product improvements, such as the healthcare sector and biotechnology stocks tends to be fairly subjected to that type of dynamic. So that's not to say that you can't trade biotechnology stocks. It just means that you have to be a little bit more difficult and more careful about the news flow there. And then, of course, technically sound stocks, and that's something we'll talk about much more in the next few webinars starting next week. We're going to talk about how various technical parameters or technical checklists are important for stocks to be able to have to pass so that they are good stocks to trade. So you don't want to trade stocks that don't have any respect at all to its various moving averages and trend lines, and in general, stocks that trade that react erratic or very unorderly, if you will, if that's a word. I would best stay away from those types of stocks. The worst stocks to trade, again, is just recapping the last webinar before we go into sectors and stocks and groups. illiquid stocks in general. Now, the US stock market is very liquid, so it's going to be difficult to come across a lot of stocks that are illiquid. There are lots of instruments that may be illiquid. If you look at everything from mutual funds to various exchange traded funds, but for the majority, all the major ETFs and stocks and major instruments will have good volume. Again, you don't want to trade stocks that are undergoing any major lawsuits and have no respect for technical analysis. So, those are the kind of stocks you want to avoid. And the tendency for big up and down gaps, big up and down surprise gaps on any given day, those are also the kind of stocks you want to avoid. We talked about liquidity. You want to focus on stocks with volume of at least 500,000 or more shares per traded every single day. That, of course, is a subjective number. Me personally, that's the number I like to focus on. That doesn't mean that you can't trade, have a lower or a higher threshold. In other words, some people like to make sure that stocks are at least having 300,000 shares or more, or some people like to trade stocks that are trading at least 1 million shares per day. So that really much depends on your personal parameters. But I think if you focus on stocks that are trading at least 500,000 shares per day, you have a very good starting point for trading U.S. stocks. And that really gets us right into what we want to talk about today, and that's the different sectors and groups. And here are just some of these sector ETFs, exchange traded funds. We'll talk about those more in just a minute. Then you have different industry groups. Again, we'll talk about this in more depth in just a minute. But essentially, the nice thing about the U.S. stock market, and I've repeated this many times already over the past few webinars, is that you can break it down into very nicely into different sectors and groups. And so this is a visual picture here that I usually like to look at, where you can see the various stocks and the size of them relative to the entire stock market by the size of the box, or at least by how much they're moving that day. So this is a nice visual to have, but you can what's on this chart right now, or on this graph, is somewhat irrelevant. What I'm trying to show you by looking at this chart is that the U.S. stock market can be divided up nicely into different parts. You can see here you have the financial sector, information technology, the energy sector, and so on and so forth. And being able to divide the market this way, and each sector has a lot of names that most people or many people recognize. Like, for example, the information technology sector has your typical stocks like Google's and Facebook's and Apple's and Microsoft. And so those are, and you'll probably find names that within the financial space as well, and most other spaces really, from that perspective. All right. Now let's continue here. We talked about that stocks, U.S. stocks tend to be great for technical analysis. Again, and that doesn't apply to every single stock, but it does apply to a lot of stocks out there. So let's move into this chart. We'll go back to this chart several times throughout today's presentation, but essentially the way I like to look at the U.S. stock market, and we talked about this, I showed you this graph last time, is I want you to picture that you sort of a bird, or a hawk in this case, that's sort of flying high above the skies, and you can look down and see the stock market. You can see the entire stock market, but below that you can see the different sectors and groups, and ultimately below that you can use stocks. You can see the different stocks and even the different options that are trading on these single name stocks. So this sort of top-down approach is something that really is helpful for anyone trading the U.S. stock market, and regardless of whether you're a beginner or you've done this for some time, or even if you're an expert. So, in fact, this is the way that, with the people that I have worked with in my career at places like JPMorgan and other places, this is the way some of the very best traders in the world look at the market, at least at the U.S. stock market, and I think this is very helpful. We'll talk about this here more in just a minute. All right. Now, like I said, the U.S. stock market can be broken down in sectors and groups or industries, and it's very nice to be able to break down the market in this way. Now, here's what we're talking about. Specifically, the S&P 500, and I'm going to talk about mostly, for today's presentation, I'm mostly going to talk about the S&P 500. Now, of course, the U.S. stock market consists of much more than just the S&P 500. The S&P 500 is, one of the major indices. It includes, as you can see, 500 different stocks, and those stocks are very big in market capitalization. They also tend to have a lot of volume. So that is a really good starting point. So if there's one sort of tip I can give anyone that wants to start trading the U.S. stock market, it is to start focusing with stocks within the S&P 500. And for that, of course, we have our Roboforex platform where you can trade those stocks very nicely. If you go into your Roboforex platform and you click here and type in the logo, you'll find many stocks that are trading in the S&P 500. And I forgot how many instruments exactly, but I thought it's more than 3,000 instruments that you can trade on this platform. So I would certainly encourage you to use this platform for trading U.S. stocks in your specific circumstance. Now, again, the S&P 500 is broken down into 11 sectors. These sectors are broken down basically by the type of company they are. So, for example, the financial sector here is divided up into banking stocks, for example, into insurance companies, and things of that nature. And you can see that it's very logically broken down. So, some of these sectors may be more interesting to you versus others. A general rule of thumb that I like to give is that I like to focus on stocks or sectors or groups of stocks that I can understand. I have, given my background, I'm not a doctor, I have a difficult time understanding, for example, many healthcare stocks, or particularly things like biotechnology stocks. That doesn't mean that you can't trade those, but as a general rule, over the past nearly 20 years as a trader, I have found that it is much better to focus on stocks that you can understand, or you can at least somewhat relate to. And so when you look at these sectors, I think it's good practice to maybe start having a little bit of focus on some of the sectors that you may want to be interested in. So if you like energy stocks, if some of you more Russia-based traders, maybe you have an insight into some energy stocks. Okay, maybe, I don't know. I'm just as an example. Maybe that's something you want to focus on. Maybe you're more interested in how banking stocks react, and of course the financial sector will be interesting. Maybe you are more into industrial stocks. Things like Caterpillar and big, large sort of global macro stories. Almost is what this comes down to. And then that would be for you. And then maybe if you're more into consumer discretionary stocks, which are your stocks that are more cyclical in nature. Okay, we'll talk about that a little bit more in just a minute. Then maybe that's a sector you want to focus on. In general, I find it's good to be able to have to not single out any specific sector and only focus on that, but rather be open to all. But if there is one or two sectors that you find more interesting than another, that is easier for you mentally to get your head around, then you can do that as well. Okay? So those are 11 sectors. Now here's the thing about those 11 sectors. Each one of these sectors is broken down into different industries, or we can also refer to those as groups. You can see that, for example, the consumer discretionary sector has about 12, or exactly 12 industries, okay, or 12 groups, and so on and so forth. And for example, the information technology space, right, that has 8 different industries. So information technology stocks are not just, companies that make computers. They could be, many different industries that still qualify as an information technology stock. So that's important to understand, because as we go deeper into these webinars over the next few weeks, you will see that not all stocks, or you'll see 2 things. You'll start to see that the stock market is actually highly correlated. About 80% of stocks tend to move up or down together, okay? At any given point in time. That means if the S&P 500 is going up, then 80% of those 500 stocks most likely are also going up on that day. If the S&P 500 is going lower on any given day, then about 80% of stocks will tend to also be going lower. If the S&P 500 is going sideways, which it also does a lot, then most of the time, most of those stocks in the S&P 500 are probably going sideways as well. So that's a bit of an overview, and we will be coming back to this. But again, just to keep in mind, the U.S. stock market is very large, and it's also made up of other parts of the market like smaller capitalization stocks, and penny stocks, and actually many other things. But I think for purposes of keeping it straightforward and giving you the best chance of making money, I believe focusing on the S&P 500 sectors is a great starting point, and most likely you won't even have to venture too much out beyond those, because the S&P 500 has all the stocks that you like, all the big ones. Maybe you also want to look at some little bit more technology specific stocks. Then you can look at things like the NASDAQ composite, but we will talk about that as well. Now, like I said before, each one of these sectors has different groups. So here, the consumer discretionary sector, which is this one right up here. If I clicked on this little plus sign, you can see we have 12 different industries. Okay, and these 12 industries are broken down into different bits here. So for example, you can see that we have automobiles. Okay, that's your automobile makers like your General Motors and those kind of stocks. Then you have media, you have specialty retail, textiles, internet and catalog retail. So it's a very diverse group of stocks that we have here, looking at this consumer discretionary sector. And now I didn't go and open up all of these sectors, but you get the idea. And let me just go through this a little bit more in detail so you can understand how big this stock market is. So within this, you have hotels, restaurants, and leisure. That is a huge group in and of itself, right? Media, specialty retail. These are all very big groups in and of themselves. So just to kind of give you an idea of how many opportunities there actually are in this market. Okay, so again, to summarize here so far, we talk about the S&P 500 itself. That's your sort of your mothership, if you will. Then you have 11 sectors that you can break this index down into, which is all these. And then within these sectors, you have the different groups or industries. Okay. Now, it's important to understand that, in my opinion, there are only really 9 sectors of the S&P 500 that I think are worth focusing on. Now, and that's because specifically the real estate sector, which is actually brand new, and the telecommunications services sector are actually not big enough to have their own exchange traded funds. So let me show you this on the next slide here, what that looks like here. So here we have the S&P 500 sector exchange traded fund. So I would like to ask you to write down these ticker symbols, and each one of these ticker symbols you can use and trade, if you like, on your Roboforex platform. So if we took, for example, put the XLY ETF in here, you can actually see the chart, and you can actually trade it here as well with one very simple click. Okay, but these are your cornerstone, or the most important bits of this entire sector and group analysis, which is to say that if you can write these down, XLY, XLP, XLK, and so on and so forth, that is a really good starting point to start having an organized way in which you approach the stock market. Okay. Okay. Now, like I said before, there are 11 sectors in the S&P 500, but 2 of those sectors, specifically telecommunication and real estate, are, in my opinion, not large enough to focus on. So, yes, you might be able to focus on some single name stocks within those sectors, but to me, these are not large enough to warrant a lot of attention in and of themselves, as far as you know, a group is concerned. All right. Now, let's make this a little bit more interesting. What we have talked about so far is your very simple sort of makeup, or your construct of these sectors and groups, or the broader stock market, the U.S. stock market. But there's also a lot of different applications in which you can actually go ahead and use those sector and group breakdowns. For example, we can consider seasonal patterns. Okay, is anyone here familiar with seasonal analysis? Seasonal analysis is, in my opinion, a very important part of analysis in the U.S. stock market. For example, right now we have the end of the calendar year here in the United States, and what that means is we tend to see there's a high probability of seeing some sort of a rally in the stock market in the last couple of weeks or so of the calendar year. We call it the Santa Claus rally. Has anyone ever heard of that term before? So basically, that is a seasonal pattern, and it repeats very, very well over time. So then you also have things like cyclical patterns, which is your patterns that you see repeating depending on where we are in the business cycle. Okay, so if we are in a expansion phase in the U.S. economy, then you would see various cyclical sectors and stocks outperform, like the consumer discretionary stocks, for example, or even industrial stocks. Volatility patterns, right, as well. If you have a period of time during the year where the stock market is acting more volatile, then there are certain sectors or groups of stocks that you can go to see less volatility. Or if you want to be exposed to more volatility, then you can find parts of the market that give you opportunities for where there's more volatility. Okay. And we'll talk about each one of these sectors more in each one of these types of patterns a little bit more in just a minute, but I just want to give you a quick overview. Then you have interest rates or the US dollar. Of course, interest rates are extremely important. Interest rates really kind of make the world go around, financial markets, and interest rates are very important to the stock market as well. This is something that should have been apparent if anyone has been following the stock market over the past 6 or 7 years. We have a very, very low level of interest rates here in the United States at the moment, as they are very low around the world for the most part, at least in the developed countries. And what what that is leading to is it's led to a lot of people to move into various different different parts of the stock market. The US dollar is very important as well, and I think we have a question coming up here already. Someone is asking, yes, exactly. Someone's asking a very good question. Someone's asking, can you use an exchange traded fund on the US dollar as a US benchmark? Yes, absolutely. The UUP ETF, that's the one I use as well. The UUP ETF is the one that I like to use. Let's type it in here, and it's, as you can see, it is available on the Roboforex platform, and that is a good benchmark to use as an exchange traded fund. If you want to use an exchange traded fund to trade, the exchange traded fund is, as a if you want to trade the US dollar index, it's called the Dixie, in an exchange traded fund format, then the UUP ETF, in my opinion, is a very good option. Okay, that's a very good question. Good. So now let's talk about some of these different volatility patterns, seasonal patterns, and all these kind of things, and what kind of opportunity could we find? Well, seasonal patterns are, these are all, each one of these are topics that we could talk about for a very long time. But let's start with seasonal patterns and just kind of go through and give you some examples. So if we talk about seasonal patterns, we have to take into consideration whether the seasonal pattern means the stock market tends to rise or it tends to go lower. So the seasonal pattern we have right now, we are in year end, as we said before, and into year end, in the last couple of weeks of the year, we tend to see a rally in the stock market, and indeed the S&P 500, as you can see, has been rallying. Now, of course, a good part of this rally has been due to the US election results, people being forced to buy stocks for one reason or another. And we now are in the last week and a half or so for 2016, the calendar year. So the Santa Claus rally would argue that we see at least a little bit more upside into the end of the year. Now, why is that? Well, there are different reasons why. They are more structural in nature. Santa Claus rallies tend to be more a function of underperforming fund managers having to basically buy a lot of the stocks that they missed during the year's rally. So this year they're probably going to have to buy various semiconductor stocks like NVIDIA. Like, for example, I'll give you a stock right now here. NVDA is the ticker symbol. We just had a very nice trade on the stock. We closed it yesterday. But this is the kind of stock that fund managers have to buy now into year end because they do something called window dressing. And these are important dynamics to be aware of, because if you're not aware of these things, these cyclical patterns, there's a good chance that you'll be fighting against that, and it's very difficult for you. In fact, it's impossible for you to win that game against the big institutional traders that have a lot of money that they have to shuffle around those stock markets. So also another seasonal pattern that is working very well right now that we are in is that US stocks tend to do very well from November all the way into March or April. Okay. So those are seasonal patterns that we want to be aware of. I don't want to go into individual stock picks right now, ABC, because that's something we're going to talk more about when we do technical analysis starting next webinar. We're still going through sort of the basic building blocks here, just to make sure that we keep it straightforward. Also, the webinar here is being recorded, so we want to make sure we don't jump around too much. But I promise you next webinar, which will be next week, if you come in and we talk about technical analysis, we can go through and look at some of the questions that you have about single individual stocks that you want to take a look at. Okay? All right, so again, let's talk about the seasonal patterns and what that means for different sectors and different groups. Now, again, we are right now in the year end. We also have the rally, the best parts of the best stock market performance in the year tends to be from November to about April. Okay, so that's, let's see, November, December, January, February, March, April. That's about 6 months of performance. So you want to be aware that when we have this seasonal pattern, the types of stocks that tend to do well, or the types of sectors that tend to do well, are, for example, your consumer discretionary stocks. They would tend to do well in that period. You would also think that when you generally have a rising market, you would have to see some sort of participation by the financial sector. Okay, most likely the healthcare sector, although there it's sometimes a little bit tricky about legislation, but also technology sectors as well, and probably industrial sectors as well. Okay, when the stock market is going higher, when you have a what we call a risk-on period, you will tend to see, all else being equal, you will tend to see some sort of underperformance. At least relative underperformance, not always, but a lot of times, in maybe consumer staple stocks, utility stocks, and maybe even telecommunication stocks, because those act a little bit more like they're defensive stocks. Okay, and so when the stock market is screaming higher, then those are the types of sectors that most likely will tend to be some sort of underperformance mode at any given point in there. And then, of course, you have the summer months. So again, we're still talking about seasonality here right now. The summer months tend to be a little bit more choppy, a little bit more sideways. So let me show you guys. Let's go back to the Roboforex platform. So if you look at, for example, this past summer, which is this period here, we had a nice breakout that took place in July in the S&P 500. Let me get rid of a couple of these lines here just to make it a little bit simpler. And then we will look at this, make it a little bit larger too. All right. So you can see this summer, for example, was a pretty classic seasonal pattern where we had the stock market, it broke out to a new high, but then it went sideways. It didn't do anything. Okay. And then we had in the autumn period, which is September, October, and parts of November, we had a little bit of a pullback. You can see that right here. And then, of course, we had a very strong rally that occurred once we had the election results come out in early November. So these are your typical seasonal patterns, and they relate to the different groups and sectors in the U.S. stock market, in the sense that when the stock market is going sideways, there's really not a whole lot to do. Maybe you'll see some outperformance by some of the more boring sectors like utilities, but it's a difficult argument to make that if the stock market is going sideways, as a general rule, it's best to do nothing or very little. Which is something we'll talk about more as well in future webinars here as we go through our 16 webinar series. But as a general rule, as you see, when we talk about different strategies, I will show you guys that most of the time when the stock market goes sideways, you don't want to be involved in the market, because the opportunities just simply aren't enough. Now, when the stock market started to rally in November, we had a lot of outperformance by the type of stocks that you typically would see, which is consumer discretionary stocks, okay, financial stocks. Information technology actually lagged a little bit at the time, but even some energy, materials, and industrial stocks. So when the rally began again in November, when we came out of the, after the summer boredom, after the pullback in the autumn months, and then we moved into the year end, then we also moved into the best 6-month period for stocks, which is November through April. Then you saw those types of stocks outperform, like I just mentioned, financials, industrials, consumer, discretionary stocks, and things of that nature. Okay, I hope this is making sense, because this is really, really important to understand. It's a very basic building block, and very few people talk about this. In fact, I've never come across anyone who teaches looking at the stock market this way first. Most people start their education by learning how to trade a technical pattern, and while I think that's important, I think this is more important to start to give you for the beginning, because again, keep in mind, we want to be the hawk, the bird here, flying high above the sky, looking down at the stock market, and we need to have perspective on the stock market and of its different sectors and groups. And if all we do is learn some sort of a technical pattern on a chart randomly, and we don't have context, it is, in my opinion, impossible to make money over time. So this is really important stuff that I'm covering today, at least in my opinion, to give you guys some color in all of this. Now let's talk about cyclical patterns. And of course, cyclical patterns come in different shapes and forms. When we talk about cyclical patterns, we really talk about, your typical cyclical bull or bear market. We tend to have two types of markets in that sense, and that's your secular and your cyclical markets. And if we talk about this for just a minute, you would see that, for example, this is the S&P 500, and it's going back all the way back to 2009, and we have been in a new cyclical bull market, or we saw a new cyclical bull market. Cyclical bull markets tend to last a few years, and cyclical bear markets are usually a little bit shorter. So the cyclical bull market tends to be a few years. This most recent one from 2009 into 2015 was a little bit longer than usual, and the cyclical bear market that we saw then since from 2015 into this past summer really was only about a year and a half long, so maybe about 18 months long. And I actually believe we are now in a new cyclical bull market within the context of a much larger, maybe 10, 15-year secular bull market. Okay. Now the question is, how does this relate to the different sectors and groups? Well, again, you can keep it very simple and understand that as long as the stock market is going high, you should see some sort of outperformance at the margin by the more cyclical stocks, at least during parts of the this of the cyclical bull market. What you want to see is, you always want to see some participation by the financial stocks. So that's in terms of sectors, that is your XLF, exchange traded fund, which includes banks. And that sector, for example, is just now starting to show a lot of relative strength. So if we go to this chart here, the XLF exchange traded fund, or this is banking stocks, they are just now starting to show a lot of relative strength. So versus the broader stock market, they had been underperforming very dramatically, actually all the way since the 2009 bottom in the financial crisis. So the financial stocks here, as of this present moment in time, the end of 2016, they are probably somewhat overbought now. And you can see we can apply some very basic technical analysis here. We'll talk about this much more in the next few webinars. But you can see we had a very clear break past resistance here. It doesn't matter how you draw the line exactly, and we're now coming into what I would think is really at least somewhat of a layer of resistance here. Depending on how you draw these lines. I would argue that we can that we'll ultimately can get back to this point. But right now, just from a pure momentum perspective, in the near term, we're probably somewhat overbought. So the financial sector, as a general rule, has to participate in bull markets. It doesn't have to lead, but it has to at least somewhat participate in order for us to say that we are in a new bull market. And now we are seeing actually not just relative, not just absolute strength. In other words, the financial sector is not just rallying; it's also rallying more, or it's also going up more than at the broader stock market, and that is usually a very good sign. Again, you know, that doesn't mean that in the near term these stocks, you know, can't, you know, pull back and may not be overbought, but through the lens of a you know 6 to 12 months or so, the financial stocks do indeed look good to continue to show at least somewhat of outperformance versus the broader stock market. Okay. So that's a little bit of your cyclical patterns. Volatility patterns, this is very important to understand as well. So when we talk about volatility patterns, we talk about periods in time when the stock market gets volatile. And what we tend to see, number one, is when the stock market gets volatile, most sectors and most stocks do tend to be volatile and do tend to go lower. So volatile markets tend to be markets that go lower, at least to some extent. So when we see that, some people try to usually then find some sort of safety in things like utility stocks. So that is your utility sector. You can see there's 5 different groups in that sector. Utility stocks are represented by the XLU ETF, which is this one, XLU. Okay, and you can see that this exchange traded fund, or this sector, also has its own, shows plenty of volatility. But when the broader stock market comes under pressure, then you would at the margin see at least a little bit more safety in utility stocks. It's not always the case, but there is a tendency for that to take place. Also, telecommunication stocks, stocks that react like utilities would also be showing a little bit less volatility. Lastly, and this is a more difficult call to make, is maybe moving into bonds when the market gets somewhat more volatile. That is very subject to where we are in the cyclical parts of the stock market, or cyclical, where we are in any given cyclical or secular bull market. But at the margin, bond prices, which you can look at in exchange traded fund terms using the TLT exchange traded fund, those tend to, and I say tend to, see some sort of refuge when the stock market is going lower. So bond prices are, can be a good hedge, at least for the intermediate term, versus an irrational or too volatile stock market. Okay, so that's important to understand as well. Now let's see, what else did we want to go through? We talked about volatility patterns, and now let's talk about interest rates and maybe the U.S. dollar, and just for a little bit here. And since we just talked about the interest rates here, well, interest rates are important to understand because they relate to many different sectors in the U.S. stock market. Most specifically, they tend to be important for the financial sector. Okay, so if interest rates go higher, or if bond yields go higher, then you will tend to see at least somewhat of a bid in banking stocks and the financial sector as a whole. Just because banks and other financial institutions make more money when you have a steepening yield curve. So without going into too much detail on this just yet, just understand that interest rates are very, very important. So the stock market doesn't just trade on earnings or other fundamentals or news flow, a big important part of a lot of parts of what companies do is the level of interest rates, right? So if you think about if a company's borrowing costs go up and they haven't taken care well of their future needs for financing, well, and interest rates go up, then that's usually not a very good sign for that company, and they tend to come under pressure. So some very interest rate sensitive parts of the market, like I said before, are financials, some consumer discretionary stocks, depending on what the situation is, real estate, and really almost any, and utility stocks as well. They actually tend to benefit when interest rates go lower. When interest rates go lower, yeah, exactly. But really any company. So think of any large company that has a need for financing. That's less important for technology stocks, but really industrial stocks and any large company that does a lot of financing. The level of interest rate is very, very important. All right. So we have just a few minutes left in today's presentation. I would love to take some more questions if you have any questions relating to this material here today. Again, to kind of just go through some things we just talked about. I hope you can see the benefit of being able to break the U.S. stock market down into different sectors and different groups, and being able to narrow down on zoom in on different parts of the market in a very organized fashion. Now, what we're going to talk about in a next video, in a next webinar, when we do some technical analysis, I will show you how you can look for relative strength and relative weakness in various parts of the market. So, one thing I always look at is I always like to see where's the money flowing. So, are financial stocks now overbought? And maybe the next sector to start going higher maybe are in material stocks, just as an example. So we need to be able to determine how to we need to be able to determine how we can see which ones are the next groups of stocks that are starting to behave well or are starting to maybe turn over and start going lower. And again, that's the beautiful thing about the U.S. stock market. It's broken down very nicely into these different groups. Each one of these groups are sensitive to various cyclicalities in the markets, in the stock market or in the business cycle, to levels of interest rates, to seasonal patterns, maybe even to political patterns. If now we are going to have a very Republican government here in the United States. What does that mean for various sectors? It's a little bit difficult to draw simple conclusions on that, but there too, there are various sensitivities to consider. So that is my overview for looking at groups and sectors for the U.S. stock market. My personal favorite, if you were to ask me what is my personal favorite sector to trade, like I said before, I prefer to be able to consider stocks in all of these sectors, but my personal favorite sector is, well, two favorite sectors are the financials and probably information technology. I also enjoy the consumer discretionary stocks because those are a lot of stocks that I personally know. Your restaurant stocks, your McDonald's stocks, your Teslas. These are all names that we have heard of, and we can somewhat understand. My personal least favorite sector to trade is healthcare. I find there's a lot of stocks in there that I just cannot understand. Also, telecommunications services stocks tend to be a little bit boring. So personally, I usually prefer not to focus on those types of stocks. Consumer staple stocks can be a little bit boring as well. Those are your typical conglomerate company that makes anything from toilet paper to toothbrushes and things like that. Can be a little bit boring. So if you want to look for more interesting price action, then I think you look for consumer discretionary stocks, financials, information technology, and every once in a while almost every day you'll start to see other opportunities in other parts of the market as well. But if you were to ask me specifically which are my favorite sectors, that would be how I would answer that question. So as we move into a new year, keep in mind that there's lots of different considerations to have. The different sectors and different groups of the market react differently depending on seasonal patterns, cyclical patterns, volatility patterns, interest rates, and the US dollar. Maybe the type of government we have at any given point, maybe on various political, geopolitical situations or tensions around the world. So there's lots of different moving parts. But again, the beautiful thing is that we can break it all down in a very nice overview, and which I think is a tremendous help for traders. So if there are no further questions, I hope you enjoyed today's presentation. Thank you for coming, and I will see you next week when we start talking a little bit more about technical analysis and how you can use technical analysis in your trading and investing using the Roboforex platform. Thank you so much, and take care.